So what if I were to tell you that even though the Federal Reserve is planning on increasing interest rates, mortgage rates could actually drop? And you're probably wondering, why is that? Well, what you got to understand is the mortgage rates are not necessarily tied to the Fed rates. They are influenced by, but they're not tied to. Mortgages are more closely tied to the 10-year Treasury bond. And what's going on right now in the 10-year Treasury is the 10-year Treasury and the mortgage rates have a very big spread between what they normally are and what they currently are. Right now there's about 300 basis point, which is about 3% difference between the two. Normally that's about 170 basis points, which is about 1.7% difference. And the reason for that is the market is expecting the 10-year Treasury to continue to climb. So the mortgage rates are pent up in anticipation of where the Treasury is going to be. But if the Fed starts to pivot and only increase interest rates by 0.5% instead of the 0.75%, that shows that the Fed is starting to pivot. And with the Fed starting to pivot, those 10-year Treasuries might not actually end up reaching as high as we expect. So all that room for margin has room to compress again. If the Fed actually only increases interest rates by 0.5%, there's a possibility that mortgage rates start to go down. That buffer between them could actually come down. You may actually see things start to drop even though the Fed increased rates. Hope that helps.